We can move on to, honestly, I think it's got to be Brennan, isn't it?
Honestly, I think that that's probably a good idea.
Honestly, you should
So,
just get into it.
yeah. Okay. So, the Honest Company, HNST on the NASDAQ, currently trading at a price of around $4 per share and a market cap of 416 million. So, the Honest Company is a personal care company dedicated to creating clean and sustainably designed products. Its products include baby clothing, diapers, wipes, nursery products, skincare, and makeup. And as Ryan said at the beginning, the company was co-founded by actress Jessica Alba, and the stock IPO'd at $16 per share in 2021, raising over 400 million. So we have covered the stock a few times on the podcast now. The first time was back in November of 2024, following the company's solid Q3 2024 results, which led the stock higher. And this was when the stock was trading in the $7.30 range. And the second time that I covered the stock was just a couple of months ago in May of 2025, while the stock was trading around $5.40 per share. At that time, I reviewed the Q1 2025 results. Now I'm going to review the Q2 2025 results here. But we have been getting quite a few questions on the business, and actually right before its Q2 results, the stock had quite a volatile day, with one of our YouTube watchers stating, "What happened with Honest today? Rug pull," despite the stock being down just 3%. Now, I must say, if you're using the definition rug pull to describe a 3% decline in the price of a business that is producing revenue and profitability, you clearly do not know what you're talking about. As for those who do not know what a rug pull is, this is a type of scam in the cryptocurrency space where developers will abandon a project, taking investor funds with them, essentially causing the price of cryptocurrency to plummet and investors left behind holding the bag. So personally, I would not use Honest Corp and rug pull in the same sentence whatsoever. But anyways, like I said, the company did report its Q2 results last week on August 6th. So let's dig into the business to see how it is looking today and whether it looks like a steal of a deal, like Andy, one of our other YouTube listeners, indicated. Potentially it does. So when we looked at the long-term financials in November of 2024, the business's revenue was growing with a compound annual growth rate of about 10% since 2019, but profitability was lacking. And although it was trending in the generally the right direction, as you can kind of see down here below on the margins that I've got up on the screen. And the same thing could be said after I reviewed the Q1 2025 result in May. Revenue growth was good. The company had reported its sixth consecutive quarter of positive EBITDA and was getting into actual positive net income. Now, looking at Q2 of 2025, revenue growth was only 0.4%, so not that great, up to 93 million. And this was driven by an increase in retail revenue, but partially offset by a decline in honest.com revenue, with management indicating that in Q2, shipments trailed consumption, partially offsetting the first quarter of 2025 results, where shipments were actually ahead of consumption by 5%. So are we seeing even, like maybe a little bit of a pull forward in Q1 because of their end customers trying to get ahead of potential tariffs? Possibly. Gross margin increased by 210 basis points to 40.4%, driven by a change in inventory reserves, partially offset by tariff costs. I'll also note that as part to mitigate the impact of tariffs, the company increased inventory on hand during the first half of 2025, but there was a bit of a tariff impact in the second quarter, and it has come sooner than management has anticipated. They indicated that in the conference call. Adjusted EBITDA was positive 7.6 million compared to 7.6 million for the same period last year. And this represents the company's seventh consecutive quarter of positive adjusted EBITDA. And net income was a gain of about 3.9 million or 3 cents per share compared to a loss of 4.1 million or 4 cents per share for the same period last year. And this is the second consecutive quarter of positive net income, with the net income margin now up to 4%. So again, great to see that we are seeing, that trend of margins increasing. They're going in the right direction. But, just generally, it does appear that the reason the stock, was down following the Q2 results were due to the slower or softer revenue growth and potentially, the earlier tariff impact that they are anticipating. Now, looking at the balance sheet, remains very healthy with cash of 72.1 million, no debt as it just has leases, and a net cash position of about 63.4 million or 57 cents per share. Now, management also reiterated its 2025 outlook following the Q2 results, guiding toward mid-single-digit revenue growth and adjusted EBITDA expected to be up about 10%. So again, we are seeing growth in revenue moderating to some degree from what it's grown at historically. And on a valuation basis, today the stock trades at about 12.4 times forward enterprise value to adjusted EBITDA, which in my opinion is starting to look much more reasonable than the other times that I covered the stock on the podcast. But cash flow is still lagging. So unfortunately, we cannot get a gauge on the valuation when it comes to cash flow. And on a forward price to earnings multiple, we're now looking at forward estimates with the business trading at about 34 times earnings. So still not necessarily cheap, but it is improving. And just generally, each time that I have covered the stock, margins have been improving. The share price is falling. So, it's understandable why the valuations are getting more appealing and more interesting here. Now, some other just comments that the CFO included on the conference call. He indicated we now expect roughly 8 million of gross tariff exposure in 2025. And for the second half revenue outlook, we will be lapping 2 large customer-specific promotional events with our 2 largest brick and mortar retailers that will not repeat this year. And he also indicated that Q3 revenue growth should be similar to that of Q2. So again, remember, it only grew at 0.4%. And Q3 EBITDA or adjusted EBITDA will likely be below Q3 of 2024. So again, although management has reiterated their guidance for the year, the profitability and revenue growth outlook for the second half of the year may be a bit weaker, actually. So to conclude here, the company has a great track record of producing high single-digit revenue growth, growing with a compound annual growth rate of 10% from 2019 to 2024. And the business has increased margins now with 7 consecutive quarters of positive adjusted EBITDA and 2 consecutive quarters of positive EPS, with that net income margin getting up to 4% or a little bit above 4% in the last quarter, which is great to see. The balance sheet remains healthy with net cash per share of 50 cents or 57 cents per share. Tariffs do remain a risk, and management indicates $8 million exposure for the year, but they reiterated their 2025 guidance, looking toward 4 to 6% revenue growth and 27 to 30 million in adjusted EBITDA. Nonetheless, management does expect Q3 revenue growth to be similar to Q2, which wasn't that great, and Q3 adjusted EBITDA to likely be down year over year. And lastly, the stock's valuation is at about 12.4 times forward adjusted EBITDA, but revenue growth is moderating in 2025. The business continues to get more appealing, but it currently faces some growth headwinds, which in my opinion could keep the stock kind of, bound to its current range in the near to midterm. If I was looking to, enter the stock or buy the stock, I'd probably be a little bit patient. It might be hard for the stock to actually go up when they're looking at some weaker results year over year generally. But again, if someone was interested, I'd be sitting in the weeds and probably just waiting for maybe that forward EV to EBITDA multiple maybe getting under 10 times. Maybe we can see that forward price to earnings multiple maybe get under 30 times. So again, it checks off a lot of boxes, but still I would be sitting on the sideline monitoring.
Yep, I agree. I think that you want to see a little more revenue growth too, right?
Yeah.
Like if you're looking at a business like this, it's nice to see them move into profitability. We'd like to see that. I'd like to see more top line revenue growth over time. and that would, maybe the share price honestly drops another 50% and you get some revenue growth, and then honestly,
Exactly.
we might look at it closer.
Even
Yeah.
12 times EV EBITDA is not a very cheap multiple. That implies to me you should be getting some growth out of that.
Yeah. And it just isn't there at this point, honestly.